Hello, everyone. Hello. I am making another Zoom video. This one's going to be a little longer because the content is longer. But this is a video that'll help with buying and selling inventory. You have an assignment on it this week, and it'll really help with that one. So make sure you watch it, give it time. Uh, it'll be worth it. So what we're dealing with is Batman is a buyer. So he's buying from Alfred, who's the seller, in the following transaction. On December 1st, Batman accepts delivery of $20,000 of merchandise it purchases for resale from Alfred. So that means it's inventory. The invoice is dated December 1st. The terms are 310 and 90 FOB shipping point. I'm going to pause right there and we're going to explain what do those terms mean. So you'll always see the terms listed like this: some number slash another number, comma, n slash another number. Let's look at the first one. This first number will always be a discount percentage. So what this means is Batman has the option of receiving a 3% discount if he pays for the goods within 10 days from the invoice date. All right, these numbers could switch. It could be 5/15, 2/30. It could be anything. But it'll always mean this first number is always the discount percentage. The second number is always the number of days you have to receive the discount percentage. Over here, n/90, this just means in total, Batman has 90 days to pay the bill, regardless of the discount. This could be anything, and it's always going to be n, but it could be slash any number. It could be n/30. That means Batman would only have 30 days to pay the bill in total. It could be n/45, anything like that. Now, FOB shipping point, you have two FOBs. FOB stands for freight on board. FOB shipping point means the buyer pays the shipping. There's another one, FOB destination. That means the seller pays the shipping. All right. When it's FOB shipping point, the shipping costs are added on to inventory value. Okay, you're going to see what that means when we do the example. So whenever the buyer has to pay the shipping, they actually add it to the total value of their inventory. FOB destination, the shipping costs are just expensed as typically delivery expense. And again, the seller pays if it's FOB destination. So you got to look out for that. The problem then goes on. The goods cost Alfred $12,000. Batman pays $500 cash to Speedy Shipping for delivery charges on the merchandise. So even though it says FOB shipping point up here, it still tells you Batman's the one that pays the cash. All right. Then we have more stuff. But first, we're going to tackle December 1st. So we're going to look at it from the buyer's point of view. Batman is buying $20,000 of merchandise it purchases for resale from Alfred. What is important is down here it says both companies, both people, use the perpetual inventory. And the gross method. So what the gross method means is there's two different methods. The gross method says that, lost my train of thought. The gross method means that you don't recognize the discount. So these terms up here, you don't recognize them unless the company actually receives them. Okay, and to make that make sense, there's another method called the net price method or the net method in general. And what the net method means is that you assume the discount is going to be taken from the very first day the transaction happens. So what that means is you actually account for the transaction using the discount terms right away. The gross method says, no, you don't do that. You just use the real numbers you have, and then you worry about the discount if it's actually received. So if Batman pays in 10 days, then you account for the discount. If he doesn't pay in 10 days, then you don't care. You just leave everything normal. So we're using the gross method. So Batman's purchasing $20,000 of merchandise from Alfred Company. All right, Batman Company doesn't care what the goods cost Alfred. Batman Company only cares what Batman Company has to pay for the goods. So I already have the accounts down here to save time because this will be a longer video. So when Batman is buying inventory, when any company is buying inventory, inventory is an asset. It's increasing. So they're going to debit it, $20,000. This doesn't necessarily say on account, but whenever you see terms generally means they put it on account. So $20,000 will go to accounts payable. So Batman owes Alfred $20,000 at some point. Next, Batman pays $500 cash for the delivery. So when the buyer has to pay for delivery, you debit merchandise inventory, $500. So it's increasing the value of the inventory only when the buyer has to pay. If the seller paid, you would not do this step. And it says he pays $500 in cash. So for the delivery, it's actually a credit to cash. Okay. Now we're going to go down for December 1st, and we're going to look at what the seller would recognize. So the seller is selling $20,000 worth of goods on account because it has terms. So they're going to recognize an accounts receivable for 20 grand, but they're also going to recognize sales revenue for 20 grand. What the seller must account for is the fact that inventory is leaving their business. So the value of their inventory, the value of Alfred's inventory is decreasing. And that's where the second line comes into play, or the third line. Alfred originally paid, or the goods originally cost Alfred $12,000. So that's the cost of goods sold for Alfred. So when inventory is sold, you recognize an expense, cost of goods sold. It doesn't say expense, but it's an expense account. And you recognize the decrease in the inventory, $12,000. All right? Next, we're done with the whole first thing. Now on December 9th, this one adds in a little twist. Batman returns $1,000 of the $20,000 of goods to Alfred, who receives them the same day and restores them to its inventory. The returned goods had cost Alfred $625. Okay? So Batman's returning $1,000 of the $20,000 of goods to Alfred. From Batman's point of view, all he has to do is recognize that $1,000 of inventory is leaving. So you got to credit inventory to decrease it. And since he didn't pay his account balance yet, it's just going to decrease the amount of money he owes. So if you bought $200 worth of clothes from a store on a credit card, and then you returned $100 of those clothes, they would just credit it back to your card. So then you only owe $100. Same theory here. Now, from Alfred's point of view, Batman owes him $1,000 less. So accounts receivable is going to be credited because it's $1,000 less that's owed. Instead of debiting sales revenue, you don't normally debit revenue. You actually debit the sales returns and allowance account. It's a contra revenue account. Like accumulated depreciation is a contra asset, this one's a contra revenue account. So you debit that, and what it's going to do is it's going to offset revenue on the income statement for Alfred Company. What Alfred also has to do is recognize that he's getting back some of his inventory. That's why it says the returned goods had cost Alfred $625. So that means Alfred's inventory is increasing by $625, and the cost of goods sold that he recognized up here is actually not $12,000 because $625 has been returned. So it has to be decreased. Okay, almost done. Here's where it's useful to use a T-chart now. We're going to get to December 10th. I'm going to make a quick T-chart, quick one, for accounts payable from Batman's point of view, and then I'm going to make one for accounts receivable from Alfred Company's point of view. Okay, if you're comfortable without doing this, don't do it. But if you need help keeping track of things, it's real useful, and I recommend it. This is a T-chart. It's the same thing as a ledger. It's just, it looks a little different, but it helps you keep track. So Batman Company originally recognized a $20,000 credit to accounts payable. Now they debited accounts payable $1,000. So how much is left that they owe Alfred, or that Batman owes Alfred? Only $19,000. All right, this is key. I want to make it money so it's more visible. On the accounts receivable, kind of same start. Alfred originally recognized that Batman owes him $20,000. He decreased the balance by $1,000. Now, what he expects to receive from Batman is $19,000. So now let's go up to December 10th. Batman pays Alfred for the amount owed. Alfred receives the cash immediately. Here's the first thing we have to say. On December 10th, when Alfred pays his balance, is it in the discount period? So let's refer up here. Batman could get a 3% discount if he pays within 10 days. This happened on December 1st. December 10th is the 10th day. So Batman would get the discount. So this is going to change the actual cash that Batman has to pay. He's getting a discount. So here, from Batman's point of view, it's really easy to start with. Accounts payable. He owes Alfred $19,000 according to his accounts payable account. You have to get rid of the accounts payable account for whatever balance it has. So we have to debit accounts payable $19,000. I left out cash down here. We're going to credit cash. Okay, but here is what we're going to look at. Here's how we're going to tackle this. Originally, the inventory cost $20,000. Then Batman returned $1,000. So in the same breath, Batman has another T chart for merchandise inventory. He originally debited it for $20,000, credited it for $1,000. So the value of the inventory is $19,000. Batman owes $19,000 less a 3% discount. So when you're getting the discount value of something, the formula would be the full value, $19,000, minus the full value, $19,000, times the discount percent. All right, if you're good with math, you could do that any way you want, but this is a great way to break it up. So when Batman calculates that, I'll break it up. $19,000, Excel doesn't like commas, times 3% is $570. So $19,000, doesn't like commas, minus 570. Batman only owes $18,430 in cash. So that's what he's going to credit cash for, $18,430. The difference, this $570, decreases the value of the inventory. So he's going to credit inventory $570. Okay? This stuff could be confusing with the discount, I know. So that's why you got to ask questions and watch the video. Now, from Alfred's point of view, since we did the math already for the buyer point of view, this is actually kind of easier. Same theory down here. Alfred has an account receivable balance that he expects to receive $19,000 from Batman. No matter what happens with the discount, this $19,000 has to go away. So we have to credit this account for $19,000. Now, Alfred is only going to receive cash because Batman's getting a discount of $18,430. The difference between the debits and the credits, that $570 that we recognize up above, from the seller's point of view, goes to this account called sales discounts. It's another account that decreases the value of sales. On the income statement, you'll see sales, then you'll see minus sales returns and allowances, minus sales discounts. Okay, so this is how it would look for each company. So I'll save this Excel sheet and I'll upload it with the video to a discussion post. Here's the thing. For this week's assignments, I don't want to see journal entries. Okay, this is a journal entry right here. There should not be a journal entry that only has one line item. There should not just be merchandise inventory debit 20,000. There needs to be always, always, always. You're hearing me say it right now. There is no excuse for not doing it any other way. Journal entries must have a debit and must have a credit. Each and every journal entry. Every time you make a journal entry, I want to see one debit and at least one credit. It could have 5 debits and 1 credit. It could have 27 debits and 1 credit. It could have 2 debits and 87 credits. They need to have at least a debit and at least a credit. Don't let me see just one line item. If I see one line item, I know you did not watch the video, and then there's nothing I can do to help you if you're lost on your assignment grade. So one debit and a credit, and then the debits must equal the credits. All right, when you have 1 and 1, the same exact value, 20,000, 20,000. You could see it better down here. For December 10th, $19,000 debit, 18,430 credit plus 570 credit equals 19,000. Debits have to equal the credit. Unacceptable for anything else. Okay? So when you're doing the assignment, even if you get lost, make sure your journal entries have a debit and a credit, and that the total debits equal the total credit. All right? Again, a longer one. I'm going to stop here. Email me questions. Over and out.